How should we read these numbers?
Well, it's a little bit at the headline level, it's kind of more of the same compared to September. But if you look at the details, there's a fundamental shifting that we had pretty much predicted. So first off, suppliers are now delivering faster. Prior to this time, they were delivering better, but they weren't delivering faster. Now they're delivering faster. And secondly, as you said, Guy, prices are now contracting for the first time. We've been on a trajectory downhill for prices heading towards contraction, and we got there, which is really good. Employment was stable month to month. Demand's essentially stable. But if you look at the four elements that make up demand, we've had backlog now contracting. Customer inventories are still too low, but making their way towards just about right. The export market is still very weak. So we're looking for demand now because the supply chain is ready to respond. The factories are ready to convert, but there's really the slowness and softening in orders over the last 6 months is taking a toll.
Tim, how do you explain what that softening is? You mentioned exports, but you also mentioned inventories. And is it a domestic demand weakness, or is it just overseas international weakness?
Well, it's a combination. So the export markets are not helping us. It's about 20% of manufacturing GDP. So in several months now, a contraction means that it's really a headwind and with no real end in sight. So, we've been slowing our order placements because of long lead times. The long lead times are still kind of stuck. They're not moving down as fast as we'd like, but I still expect in the next month or two we'll see that. But the good thing here is that prices are dropping, which should bring more buyers into the market because they can feel with a relative level of confidence that they're not going to be paying a higher price 2-3 months from now than they will 2 or 3 months from now. So, we're above 50. The rest of the world, China and Europe, is not expanding. We're still expanding. We've been 50.2, 50.9. That essentially says we're stable month to month. It feels like it's being managed well.
Let's talk about the employment data. Why are companies holding on to labor right now?
So as I mentioned last month, we had a big shift from a 10-to-1 hire to fire ratio based on the panelists' comments. We had 10 companies hiring, 1 trading or freezing. And last month we had a 2-to-1. This month, in the month of October, we had a 2-to-1 too. So panelist companies are still very cautious about expanding headcount. They're very concerned still about Q1 of next year, what it really is going to look like for them. They don't want to add to their severance issues by continuing to add people, yet they don't want to lose people either. So the people who are still hiring are still having some amount of difficulty. The quits rate is still consistent with the month of September. So overall, I think we're in a pretty good position here. I mean, we're not moving in any great swings, which is really positive.
Hey, Tim, just to focus on jobs for one moment. You mentioned that companies are not willing to really hire a lot because they don't know about Q1. Talk about how they're willing to fire or not. Are we looking at a world where companies are going to hold on to employers because they didn't want to go into the squeeze that we saw back in 2020?
Yeah, good point. So as in September, we have a 2-to-1 hire to force manage ratio, hire to fire, I call it. The companies that are firing are not really firing, they're freezing. Or they're allowing themselves to attrit down. If 3 people quit, they replace 2. That was very consistent with the month of October, too. Very little signs of people laying off in any kind of significant amount. So we're still in that mode where they're trying to manage their headcount. They don't want to lose people that they've worked the last 2.5 years to get, but they don't want to add to that headcount so that they may have to do something more drastic in Q1.
Let's talk about Q1. You keep bringing it up, Tim. We've got stagnation now, but we're heading towards a more difficult Q1. How difficult will Q1 be? Are we heading for a recession?
Well, I don't know that I can predict that, but I don't know that we're going to see the 35-month average cycle on manufacturing expansion. We're now in month 29, but we're getting very close now to a 51. The sentiment about demand, positive versus not so positive, is still around 2-to-1, down from what was an 8 to 10-to-1. That was consistent in the month of October also. But there's still indications of softening. Softening meaning that when you're finishing orders way out in your order book, they're not being replaced with new orders. So we're probably, across the 18 industry sectors, we're probably getting very close now to the normal, what would be a normal buyer placement period. So we've been at this now for 5 months. The new order rate has been very weak. You're seeing the backlog now drop, which means every month that we ship product, we're chewing into our backlog. which always makes companies nervous. So, but again, we're not seeing any large-scale layoffs, so I don't believe the panelist companies are nervous about November or December.
Hey, Tim, I'm just looking at market reaction here. S&P giving up all of its gains, now flat, probably going into negative territory here. Also, a big part of that was the JOLTS number coming in super strong. So the market interpreting it as the Fed's going to have to go harder, faster, and go longer. If we see consecutive 75 basis point hikes, that becomes more the norm, and we don't get the kind of a slowdown in rate hikes that we expected. What does this data look like in a couple months?
Well, you would think that the durable goods, the machinery index, the capital goods stuff would start to really ease. You would think that you would see prices drop even further, and you'd see lead times come down. So I think the big indication for me for November and December is, are those lead times going to come back down as they should? Because people are waiting for that. You got prices down, suppliers delivering better, easier to hire people. The quits rate showed some amount of slowing, not a large amount, but a little bit of slowing in the October timeframe. Same thing in September. Confidence about the future is still a little bit questionable. In the near term, I think we're in a pretty good place. So we'll see. Hey, as interest rates go up, a lot of pressure on the building construction products area. That impacts a lot of our industry sectors. Our chemical products group, number 2 industry sector, supports pretty much all the other industries, and it's had 4 straight months of contraction. So it's feeling the pain of that. In the month of October, we saw our computer and electronics sector go into contraction also, which was a little concerning. So our number 1 and number 2 industry sectors, which make up about 30% of manufacturing GDP, are now contracting. So, and a lot of that has to do with the fact that the new order levels just aren't there. Primarily driven because we had super full order books that we're now allowing to kind of bleed down into something that's normal. Good sign here, suppliers are delivering faster, prices are coming down finally. So we'll see where we end up.